Welcome to the All Things Wildfire podcast, where we delve into the latest trends and hot topics in protecting properties against wildfire. So sit back, relax, and join us as we arm you against disaster.
Guys, so welcome to another podcast of All Things Wildfire. And today I'm interviewing someone who's very special and dear to my heart, but his name is Tim Bauer. But I wanted to get Tim on because Tim has been involved with working with brokers, insurance companies, family offices, etc., on what they're doing and what obstacles they are running into. So, Tim, can you introduce yourself and then speak a little bit about what the trouble is? Then I got a few questions for you.
Absolutely, yeah. So my name is Tim Bauer. I am Senior Vice President over the Private Client Group at Allied Restoration Services. And Allied Restoration Services performs full service disaster mitigation and restoration. And we specialize in working with high net worth, ultra high net worth, celebrity entertainment, and the like. We're based in Southern California. So we're real close to Beverly Hills and Malibu, Brentwood and Bel Air, all of these towns that people across the country may have seen on television over the years. And about 5 years ago, we started to not only just do water damage services, but we started getting invited in as a result of all of the major wildfires. And, disaster restoration companies like Allied were very busy for a number of years. In fact, it's crazy. Even today, only a fraction of the houses that burned down in Malibu during the Woolsey fire, now almost 5 years ago, have, still not been rebuilt to this day. Yeah, which is just crazy to think about. But what started to occur a few years ago is the brokers and family offices that were referring us water damage business, fire restoration business, they were calling us because they were no longer able to even get insurance coverage for their clients. And so we've been seeing this trend over the last few years where the market has become very hard. And insurance brokers can tell you this is the hardest market in California history ever to place insurance. Now, traditionally, Californians have enjoyed lower insurance premiums as it relates to percentage of income. Our houses are more expensive. So overall, we tend to have higher premiums. But when you calculated the amount of premiums spent per capita and per income that we have here in California, we were actually the 10th least expensive market for insurance in the country prior to these major wildfires. Now,
And
fast
Tim,
forward to
just jump in.
2023. Sure.
I get what you're saying, and that's cool. But to a homeowner, to the end user, I don't care that I was getting a deal for all these years. All I know is whoa, premiums have jumped up. And I can tell you for me personally, because I live in the WUI, right, in the wildland urban interface, my premiums when I renewed this last year, 5 times. It went up 5 times. So I know, we know people in the WUI, man, they're struggling. And I know you've got some stories of some crazy things that are going on. Let's first talk about some of the craziness that's happening as far as, some of the non-renewals, what people are doing, some of them are self-insuring, right? And so all this crazy stuff that's going on, and then I'll bridge over to some additional questions, but can you share some of those horror stories?
Yeah, so what insureds have had to do to adapt is basically be willing to accept whatever kind of insurance coverage they can get at whatever cost it's offered. The marketplace has become so difficult, which is tough for people like you, OP, because on one hand, yes, you are in a wildland and urban interface, but on the other hand, your home has never suffered a loss. And this is one of the biggest things we hear in the disaster restoration side is homeowners feel like, why is the insurance company not treating me nice? This is my first claim. I have been paying my premiums for 30 years. I've never had an incident. And now my neighbor has a fire and I get punished, right? And it feels very unfair. So what ends up occurring for a lot of these individuals is, like you, they're facing 5 times increases. Sometimes in some of the higher end neighborhoods, we're seeing 10x increases in their properties in numbers that rival the median home price in a lot of other states. That's how much Californians are paying for insurance in higher-end properties, which is alarming to say the least. And so to your point, OP, some homeowners are left with the question, do I pay $1 million a year for insurance, or do I just kind of put my chips on the table and risk it to not pay my $1 million premiums and do what we call self-insure? And self-insure is just a really fancy way of saying live without insurance and pray for the best. So what a lot of clients have chosen to do is to self-insure with risk mitigation. Now, large corporations have been doing this for years. A company, if you think about like a Fortune 500 retailer, right, that has, footprints all over the country, they can manage their risk by saving some of their money, by setting money aside for insurance claims as they arise. Cities and municipalities tend to work similarly. But now high net worth individuals in a lot of cases are also thinking, maybe I'm just going to follow that same business model. So that's step one. Do I self-insure?
Yeah. So really quick,
yeah.
Hold on, Tim. Like, you lost me. I mean, some of the listeners might go, oh, cool, I understand $1 million premium. I don't understand $1 million premium. Is that real? Like, how real is that? Now, I'm sure you're about to tell me these are for high net worth clients, right?
Sure.
And they probably have properties all over the place. But for and I guess the thought is, the people that live in the WUI, they're not all celebrities. They're not all ultra high net worth. They typically have a little higher end on the, as far as income, because they're able to live in those areas where there's more privacy, more seclusion and stuff like that. What's a realistic number of other homes that you've heard where they've jumped up in pricing? What can you give me an example of that? Yeah,
so you might see 200 to 500% increases in those areas. And again, those are 200 to 500% increases from a much smaller number. But I don't care who you are, when your annual insurance expense doubles, triples, it's even harder for the average American. And let me be clear, I'm not one of these individuals. I don't have a $1 million premium on my home, right? I don't have a $200 million art collection that I'm insuring, or a watch collection, or jewelry. I don't have to worry about insuring that type of stuff. But for those homeowners, a lot of them are turning to things like California Fair Plan. And so California Fair Plan is an option for quote unquote regular homeowners like you and me. They offer greatly reduced limits. You can only insure your property up to $2.5 million on the California Fair Plan, which, again, for you or me, no big deal, right? That's plenty for our house. The problem is that the limit can be very misleading, because while on one hand, they will pay up to $2.5 million, they have a number of exclusions on their policy that keep you from actually being able to recover all of the money that it takes to rebuild your home. The worst part is that California Fair Plan will almost never pay for smoke mitigation. And what a lot of people don't realize, in Woolsey, for example, 500 homes burnt. They actually were damaged by fire, but every single property in Malibu had soot and ash blow into those properties. And this is not the type of thing that you can grab a Swiffer and take care of in a couple of hours. It's so pervasive. It gets into attics, it gets into floor spaces, it gets anywhere and everywhere. And to the point where we got a lot of calls, even 6 months later, where they're like, look, we cleaned our house 10 times and it still smells like smoke. We go out there, find out they're with California Fair Plan, and unfortunately they have to pay out of pocket to deal with the smoke mitigation. On top of that, they have limited coverage for their contents, their personal property inside, which most homeowners, they care more about their stuff than they do about their house. And when you're with California Fair Plan, you may not have any insurance on your stuff, or very limited.
Got it. Okay. So, and I think hopefully the homeowners that have to deal with the Fair Plan, the brokers are explaining the limitations, the risk that they're taking, et cetera. Now, how long, in your opinion, are these increases going to last? Like, how long? I mean, is the worst over, right? Or can we expect this in the future to increase even more? And then if, like, AIG, right? They basically said, hey, we're out of here, out of
Yeah.
California. Where are people going now if they can't go to market with AIG or other insureds that are working within the Department of Insurance regulations? What are the options for these people? What's happening?
Yeah. So to answer your first question, I've heard experts say that we're looking at a minimum of 5 years, potentially even up to 10 years to see
Of
these rates
increase.
of increase continue to occur. Because the unfortunate reality is that wildfires are not going away. And if anything, they're getting worse. They're occurring. The wildfire season has more than doubled. We're seeing more losses now. 2022, knock on wood, was a great year in terms of wildfire. It was very minimal. There weren't huge events. In fact, in California, we probably suffered more rainstorm events than we did wildfire. But anyone who's lived in California longer than a season can tell you that we can't expect that to continue. We're going to have wildfire seasons come back. And, with climate change and other factors, we're going to continue to have an issue. We have an overtaxed power grid. We've got all kinds of problems here that are going to lead to continued wildfires. Now, in terms of other marketplaces, OP, we attended the Private Risk Manager Association annual summit recently. And, while we don't want to mention names of specific carriers, most of the high-end carriers that insure high-end properties in California were there. And every single one we listened to mentioned that they're pulling out of California. They're not writing what they call admitted business in the state of California. And so people are turning to what they call non-admitted carriers. And so the way this works, without getting too technical, is in California, we have a Department of Insurance that regulates all insurance products that are sold in the state of California. And in admitted markets, if I'm an insurance company, let's say I start, Tim Insurance Company, I need to send my policy papers, which are the contracts of insurance, into the Department of Insurance, and they approve each form for me. They approve the pricing I can charge. They approve everything about that policy. It also requires me to follow a bunch of regulations. Now, the non-admitted carriers, or insurance wholesalers, they're oftentimes called as well, what they're able to do is they're able to go to the non-admitted markets, these wholesalers, and they're able to create specific policies. So, for example, a non-admitted policy could carve out a different type of coverage for wildfire insurance, maybe with a $1 million deductible. So I'm self-insuring for the first $1 million, but my insurance, if a pipe breaks or if I have, wind damage or other types of claims, I'm covered and I have a great insurance product for those types of perils. But the challenge is that wildfire becoming increasingly more common. To not have wildfire coverage is like, I don't have auto coverage anytime somebody hits me from the back or the left, right? I'm covered if they hit me on the right or the front, right? And that's not the best kind of coverage. I want to be covered no matter what and taken care of. The other problem is that non-admitted coverage is they're allowed to price much more liberally. They're allowed to charge more money for the services, which on one hand, for those that can afford it, it's a great benefit because it allows them to secure insurance. But for normal Californians, and I know, if you live outside of California, you may think that we're all, we all go home and, dive into our pool of gold and swim around in all our money. But
drive around with a Lambo.
Exactly. But we, a lot of Californians live check to check and they're struggling to make it, and wholesale coverage is oftentimes just not an option for them. So they end up sticking with California Fair Plan, which is unfortunate because while brokers are very responsible, they do a great job of communicating these things. Most of us don't listen. We buy insurance, with premiums in mind. In fact, I'll do a little exercise with you that I love to do with people. I say, if I'm in a room of individuals, I say, how many of you know your policy limits on your auto coverage and your homeowners coverage. Very few people will raise their hand. But if I say, how much money is your premium? How much money do you pay for it? Almost everybody has at least a general idea, maybe not to the dollar, but I know within a couple of $100 what my insurance premiums are. We only think about what we're paying for insurance and not for what we're paying for until we have a claim, and then it's too late.
Yeah, man, it's so true, because I answered the question the way that you said. It is, all I know is how much I'm actually paying, right? And I'm not paying enough attention to the bottom line or to the fine print. Now, okay, let me just ask you another question regarding non-admitted carriers. What's the risk for the homeowner to go with a non-admitted carrier? Because if they're an admitted carrier, you find that, California maybe, or the state has created these boundaries, right, that the carriers need to play in, so I don't get hurt, and they're managed. But what's the risk for the homeowner to go outside of that? And I know that that the non-admitted area is growing because it needs to, but is there some inherent risk in going with a non-admitted carrier?
Yeah, I would say the biggest risk is not really understanding what you're buying, right? To my point, most insurance buyers tend not to be that sophisticated about their insurance purchases, not because they're not intelligent enough to understand, just because if you're not having an insurance claim, why would you read that 30-page contract, right? So we tend to just sign at the dotted line. Non-admitted products tend not to be as robust, right? There's limitations on them. And if you as an insurance buyer don't do a good job of understanding those things and communicating with your broker about everything that needs to be covered and how, you may end up with a product that doesn't cover you like you expect it to. And I would say that would be one of the biggest risks. These companies are still extremely, they're financially fine. They're liquid organizations. These aren't, fly by night agencies that are operating out of somebody's garage promising insurance. These are the most prestigious company is Lloyd's of London. That's the one that you'll hear most. Lloyd's of London is a prestigious name. It's just a wholesale insurance product that doesn't always insure the same way that we expect our products to insure.
Got it. Well, I think, Tim, in wrapping this up, kind of what's happening in my mind is I'm thinking, man, we're in a new age, and not only is the economy like rockets are flying off everywhere, right? And now literally also, right, with what we have going on with Russia, Ukraine, the impact the United States has on that. There's just a lot of uncertainty going on. In addition to prices getting higher, everything's going up. Inflation's crazy and about to get crazier from what they say. So there's so much happening in the world, and I guess insurance is just part of that too. And the wildfires have been carrying this history for the last 5-7 years and going, hey guys, you better pay attention, because now we have a massive, massive problem. Specifically in areas like California, now Colorado is struggling, Montana's got issues, New Mexico, it's crazy. But it sounds like the carriers are saying, hey, I'm gonna tap out, guys, and I'm gonna need you as an insured to share in the risk with us. You have to do these home hardening things that we've covered in previous podcasts, that these are the things you have to do so you could share in the risk with us. And then hopefully, as time goes on and the customers do those things, they can make themselves more insurable for the future, right? And I think that's what we all as homeowners hope, that if I'm going to do this work, not only, yes, the benefit is I'm going to be able to feel better about, my home surviving, but I'm going to trust that maybe the carriers, when it comes time for renewal, is going to see the efforts that I put in and maybe give me a little grace and treat me a little better. And maybe other carriers might look at me also and throw their bid into the hat, right? Because right now it feels like, the carriers are just saying, boom, here's my price, take it or leave it. I don't blame them. I understand they've lost their tail, but it sounds like we're going to need to put our part in the years to come. Is that kind of what you're feeling?
I will say that's absolutely correct. And even if we weren't in the place that we're at today, even if insurance premiums weren't rising significantly, even if admitted carriers weren't leaving in droves, if you could spend, let's say it's going to cost you $2,000 to $5,000 a year to prevent a claim from occurring, I promise you, ask people that have been through a house fire, if you could have, a year before the fire, paid $2,000 out of pocket not to go through that, would you have paid it? Absolutely. The answer is yes. And insurance companies, while they may cover the financial losses, they don't cover the time loss you lose in your home. They don't cover the loss of focus, the trauma of having a house fire, especially if you have a family with young children. The trauma of these events cannot be understated. And so I think that whether you want to make your house more attractive to insurance companies, or you just want to make sure you never go through this on your own, it's worth taking small measures. There's a lot of little things that I know will be covered on this podcast in coming months and years is, what can you do around your home that is relatively small to clean things up? It's not dissimilar from exercise, right? If a doctor told you if you exercise 20 minutes a day, 5 days a week, your chances of having a heart attack are cut by 90%. You're going to have to spend that time, but it's worth it. It's worth it. Your home just needs a little exercise, and it can be significantly safer. The risk can be reduced enormously, and insurance companies will be more likely to look at your property, with more healthy eyes and more forgiving premiums.
Boom. Well, Tim, thank you very much, brother. As we close, again, I appreciate your wisdom, your expertise, and I really now, after talking to you, I'm like, okay, I have some other experts that I definitely want to get on. That I'm like, okay, yes, we need to pull some people in that can speak even at a deeper level as to the struggles they are dealing with to get their clients insurance, because on the back end, there's probably a wrestling match going on, right? Between the provider, the broker, the family office, like this wrestling match trying to help their customers. So I'll build the list on exactly who we want on here. But thank you again, Tim. We really do appreciate it. And for everyone else, guys, thank you for listening in. Subscribe, and we'll talk to you soon. Peace out.
Later.
That's all for this episode of All Things Wildfire. If you like this episode, be sure to subscribe to our show and follow us on social media to stay up to date on all things wildfire. And as always, thanks for listening.